And we are back. All right, so looking at the chart patterns right now, back looking at chart patterns. So what are chart patterns? So what are chart patterns? Chart patterns are formations of prices, consecutive formation of prices that some believes will signal a potential trade opportunity. Right? It's a formation of series of chart of prices where they identify that it might give you a trading opportunity. Common uses of chart patterns is really to identify changes in trend or what we call reversals. So what you notice is this is why it's leading on from trend. You need to identify trend, and then now we identify potential reversals. Again, remember, reversals or counter trend do work, but they work about 30% of the time. So there are several chart patterns that we can take note of, such as the double top, the head and shoulders, the rising wedge, the double bottom, inverse head and shoulder, and the falling wedge. Again, some of these chart patterns we do go into a lot more detail in the Traders Club with those mini courses. Please make sure you refer back to those chart pattern mini courses if you want to find out more about chart patterns. Personally, I use some chart patterns, but you also want to take note that there are some problems with chart patterns. What are the problems? Identifying, adjusting chart patterns in live market conditions are not always going to look like the textbook methods that we show you here on screen. Very seldom are you able to draw those straight lines across or straight diagonal lines to tell you where to get into a trade or where to get out of a trade. So understanding and having confidence in using those chart patterns is going to be crucial. If you trade only with chart patterns and you enter a trade only because of a falling wedge, for example, you might not have a lot of confidence if prices starts going against you. But if you have chart patterns in addition to economics, in addition to trend, and some indicators or price action, you'll have a little bit more confidence in the trade. You might be able to enter that having confidence and understanding, be able to hold on to that trade if it does go against you in a short period of time. So that you have to understand these potential problems with chart patterns before you start deploying them as part of your trading strategy. Again, in theory, a head and shoulder pattern looks like it's quite straightforward. You got a horizontal line, neckline, it bounces off the neckline twice, it breaks through on the third time, you enter when it breaks the neckline, you put your stop loss above, you take profit below. But in reality, if you look at a head and shoulder pattern, necklines are not always horizontal. Necklines can be slightly diagonal. Shoulders are not always equal height. Shoulders also can be slightly skewed. So with that, you actually need to know how to draw your neckline, how to identify a proper head and shoulder, and also the key points of where to put in your entry point, your stop loss, and your take profits. At this 4-day program, I'm not going to be going through about how to enter based on chart patterns. I'm not going to be going through the details. We have that all in the Traders Club in the mini course. Also because I will only be sharing with you the chart patterns that I actually use quite frequently. For example, the range rectangles. The range rectangles, which also indicates some consolidation, is when market moves in a horizontal range or moves across. As you can see in those rectangles there, it's been moving across with little or no direction. It's moving across. This indicates that the market is waiting, could be waiting for some news to happen. And if that news does come out positive, we might see prices shoot up. If it comes out negative, we might see prices shoot down. So it's going to have a significant impact on price. So what we're talking about, these news are big impact news, high impact news. And if you refer back to the pyramids, it's probably going to be one of those on the top of the pyramids, one of those with higher volatility expected. Refer back to the pyramids if you're unsure about which economic news we're talking about. So that's range rectangles. It's something that is easy. Why I use this is it's easy to identify. It's straightforward. Everyone can draw a rectangle. It's not hard to draw. The next thing I use are also the double bottoms. The double bottom indicates how price has been unable to move lower. It hits the bottom once, bounce up, hits again, bounce up. And at that point, if something has hit the bottom twice, most likely we're going to see is a continuation upwards, a move upwards. And it's possibly going to be a strong move upwards. The double bottom or the double top are also characteristics of a support and resistance level. Support and resistance, that's where I'll come into on the next segment. But at a double top, what you'll see is it's hit the top, came down, hit the top, came down, and you expect to see that drop significantly. So again, double bottom is a support level, double top is a resistance level. Those levels are actually key to tell you whether prices could go higher or could go lower. With that, we come into the support and resistance